Hello there, welcome. Thank you for joining us today. My name is Marcia Butler. I am the webinar director here at Advice Chaser. We're so glad to have you here. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation and a couple of notes to our attendees. If you would like to ask a question, go ahead and put that in the chat box. And we encourage you to do so if you want clarification or if you just want expansion of a particular topic or if you want a topic brought up. The presenters will answer those queries during or after the webinar today as appropriate. And if we're not able to get to it, go ahead and leave your contact information in the chat box as well. And we'll make sure someone reaches out to you after today's event. Again, that chat box is there for you to use and interact with us. I'd love to introduce you to our presenters today. Let me go ahead and get this up. Sheldon Sweeney has taken a unique path to arrive in the financial services industry. After graduating from California Maritime Academy with a BS degree in nautical industrial technology, he worked in the industrial marketplace for many years. Ultimately, his love for client service led him to a career in financial services as a protection specialist with a major fraternal insurer. However, he found he couldn't fully service his clients with their limited insurance options. And Sheldon enjoys helping families who are planning for retirement, as well as business owners who need advice on creating an exit plan while protecting the business they have built. Starting in 2012, Sheldon built his business at Pacific Capital Resource Group, Inc. in Bellevue, Washington, as a financial advisor, establishing niches. Sheldon then received an opportunity to move his business to Snyder Financial Group as a wealth advisor in 2019. Sheldon holds 3 designations: the Chartered Special Needs Consultant, Retirement Income Certified Professional, and the Chartered Financial Consultant. He is also disability and life licensed. And Sheldon, we're so excited to have you back. You can go ahead and say hello so we can see you on camera.
All right, thank you, Marcia. It's great to be here. Hello, everybody.
All right. And our second guest today is Jonna Long. Jonna is a tax professional with a master's degree in professional accounting, focusing on taxation. She has experience working in the Big Four firms, as well as regional firms serving high net worth individuals and businesses. She is the founding CPA of FinTax Partners. And we're so excited to have you here, Jonna. Go ahead and say hello so we can see your face too.
Hello, everyone. Thank you so much for having me today. I'm excited to talk to everyone.
All right. Well, we're going to go ahead and kick this off. And I believe, Sheldon, you were going to start, and I'll turn the time over to you.
All right. Thank you again, Marcia. And it's great to be on this webinar today with Jonna. We're excited for everyone who's able to log into this live conversation. And that's how we intend this educational piece to be, is conversational back and forth between Jonna and myself, so we can sort of paint a picture, kind of a model of, I'd say, a best case scenario where you can take your financial planning into consideration with tax to have those two different perspectives so that we're not getting too isolated in one silo, either 100% focused on tax or 100% focused on some particular financial strategy. So when we have this perspective, I would say this is a ideal model. Ideally, a person could be getting good financial advice, good tax advice, and good estate planning advice from a estate planning attorney. So today we'll focus on the two lanes of financial planning and then having access also to a CPA. Jonna and I happen to collaborate quite often on behalf of clients, so most of our stories will be in that regard today. And of course, in planning, you're going to have today's situation. Most planning, we just have to take today's facts, do the best we can with today, and let the future unfold. But I think in the tax area, and I'll get Jonna's input on this real quick, but to have a proactive tax approach, I've worked with a variety of CPAs over the years, and I think you're best suited to find a CPA that can be proactive in thinking about tax strategies. So as you finish off a year, what's next year going to look like? So you don't get any tax surprises on that. So Jonna, I'd invite you in to comment on that as well.
Yeah, I think that what you hit on, Sheldon, is a big point of really, oftentimes when you're working with your CPA, they're simply collecting your documents after the year's already happened, and it's really eliminating any opportunity for future planning. So I think that when you're looking for a CPA, finding a CPA that's really in tune to what's going on during the year, what do we think that next year is going to look like, and really creating and adapting and changing a strategy as you go on, not just with each other, yourself and your CPA, but tapping in your financial advisor as well. And that's really what Sheldon and I are going to talk about more today, is just, what are some strategies that we think that you should be talking about with your CPA and wealth advisor, and what's the most optimum way to be working with your professionals, whether you are just an individual engaging with a CPA or a financial advisor, or if you're a financial advisor working with a CPA, whatever that situation may be, there's really huge benefits that can be seen from working together and planning ahead.
All right. So this area of balance is a recurring theme, I think, that you'll find with a lot of financial advisors. So I would like to just point out that when you combine what you're thinking about, you've heard buckets of money referred to a lot, and I think that's appropriate, whether it's a bucket or whatever you're carrying your money around in, that money is going to be in different silos. So it might be in a retirement silo, it might be your 401ks and your IRAs. Those have certain tax considerations. You might have cash in the bank, cash savings, different tax consideration. You might have other investments with your stocks and bonds, so kind of a tax as you go kind of a strategy. And I've watched as people progress from young savers to midlife on through retirement and then deep into retirement. And I think people are best served by having money in these different buckets, in these different silos, especially as they progress into years of retirement. So that's where a lot of these strategies that John and I come up with are, what is the purpose of the money, and then how is that going to be taxed? But the people that I think get the most hamstrung are the ones that get, for example, they're told their whole life, put everything in your 401k, max out your 401k. Okay, good advice to an extent, but if you end up and that's where all your money is in retirement, you're very restricted on how you can access money, because then you're taxed on that money as income when you pull it out of your 401k or your IRA. So balance across the board is going to be the best way to address that.
I think too, before we move on to the next slide, balance of where you're putting your money and how you're handling your money, and also balance of why are you engaging in a specific strategy? Are you doing it for just tax purposes, or are you doing it for a financial perspective? Having the balance and tapping into your different professional advisors is going to allow you to make a decision that's best on a holistic perspective.
And so John and I are also very careful. We're trying not to, in this webinar or even when we're live with our clients, is to talk, not use jargon. So excuses if we use financial or tax jargon. We're trying to make this as approachable and understandable as possible. So on the slide, you see tax deferred. That just means that, you know, you do have some tax benefits by not having that money count towards your income in that given tax year. But remember, you're going to pay tax on that when it comes out in retirement. So that's why it's called tax deferred when you're talking about 401ks and IRAs. So getting a current year benefit, kind of kicking the can down the road. So when this gets into the strategy. So sometimes people will say, well, how much should I put in my Roth versus in a 401k? It's not ever a clear-cut answer. And this is, again, where it comes into balance. I mean, it could come into like a 50-50 split, because it is, at the end of the day, this is a tax strategy. Do I want to pay my tax now? Does it make more sense to pay it today and put it in a Roth? Or do I want that current year benefit to then pay that tax in the future? So there's always assumptions that go on with that. One of the assumptions could be that tax laws are never going to change, or that tax laws are going to change, or that assuming that you'll be in a lower tax bracket in the future, that would assume that maybe tax laws don't change. So lots of considerations here, and that's why it's super important to get that perspective from a financial person and from a tax professional.
Yeah, and I think that that's really the key too of having a CPA that works with your financial advisors is, you know, you can look at today's landscape. This is what I know my tax bracket is in now, but what may happen in the future. And it's hard just to be working with a CPA alone, because CPA may not know your whole financial landscape. They may not know, okay, well, what money are you going to start receiving, 10, 20, 30 years down the line? What might that make your tax brackets look like? And so really circling back in that balance of where is your money and what is going to happen from a tax perspective and from a cash flow perspective when you approach that retirement age.
I have a question here. The question is, how often do CPAs and financial advisors work together? Is it common, or is it somewhat uncommon?
I would anticipate that Sheldon and I will have very similar answers to this. In my experience, it hasn't historically been common. I am seeing it starting to happen more and more, but I would still say that it is not happening as frequently as I would like to see for people. Sheldon, I would assume that your answer would be somewhat similar. I'm curious to hear your thoughts.
Yeah, no, thank you, Jonna. It is. I don't think it's as common as it should be. And that was part of our purpose, was joining together on this webinar today to just put this model out there. So no matter where you are in the country, you can sometimes find a firm that will have CPAs and financial advisors under the same roof. You'll find, I think a good question for a financial advisor to ask is, could I be introduced to your CPA? And to open up that conversation. That is a very much, I consider, a best practice. And I don't want to leave out that estate planning attorney as well. I mean, if you have those three professionals talking to each other and as a team on your behalf, that's how Jonna and I would propose to, support a client. And so I think it sometimes depends on where you are in the country, how more or less we're in the Seattle area. I think it's a little more common in this area, but across the country, I know that it's probably not happening as much as it should.
I think too, you can always take the ownership on yourself when you're either trying to find a CPA or trying to find a financial advisor if you don't yet have them. It's always a good question to ask, like, one, to Sheldon's point, what is your relationship like? Do you have a CPA you regularly work with? Or on the flip side, to your CPA, do you have a wealth advisor you regularly work with? And if the answer is no, then maybe it's would you be willing to have a meeting with my wealth advisor, something like that. Pose the question. Like Sheldon said, we're really here just to spread the knowledge that this is a good strategy to have, and hopefully you can take that bit back to your CPAs or financial advisors.
Thanks
Yeah,
so much.
hopefully that helped. I mean, the thing is that I've never had anyone decline that introduction. So, and you know, it's sometimes that question's just not being asked, I think is all that it is. But once someone says, oh yeah, please talk to my CPA, usually you have to sign some sort of disclosure that the client's authorizing these two professionals to talk with one another, and then it should always be in your best interest at that point forward. So understanding your employer benefits, this is just I guess a nugget that I wanted to throw out there, that it's much more common now that there is a Roth option inside of your 401k benefit plan at work, and that has much higher annual limits that you can put into it than if it's a Roth IRA. So unpacking employer benefits a lot of times will start in the camp of the financial advisor, and then bouncing that off the CPA to see in that given tax year what is the best strategy for high income earners. You know, you get to that threshold. This, I'll bring Jana in on this, but sometimes we're right on a tax bracket difference, and it might be not, don't want to go overboard on the Roth concept, the Roth option. If you're about to go into a new tax bracket, that might be a year where Jana would say, well, we actually need that 401k help. So Jana, you want to talk about that?
Yeah, I mean, I think it's really just going back to that bucket concept of managing, well, what money is pre-tax, meaning you have not paid the taxes, or post-tax, which means you have paid the taxes. Do you want to pay those taxes this year? Does it make sense to pay these taxes this year? Does it make sense to wait in the future? These are conversations and questions that should be posed by your CPA and your wealth advisor. And if they're working hand in hand, they can make that decision of, oh, we do want to accelerate some conversions this year because it makes sense. There's a lot of moving factors, and that's why it's so important to have that collaboration between your advisors.
Can you talk a little bit about why you might want to avoid going up in the next tax bracket? Can you explain why that strategy is important?
Yeah, so the way that tax brackets work, it's based on a marginal rate. So you have these brackets, so let's say 15, 20, 25. I'm just throwing in numbers out there. Those are not the tax brackets necessarily. The way that the tax brackets work is it'll say if you have up to, say, $100,000 of income, you'll be taxed at the 15% level. The minute you go over the $100,000, even if it's $101,000, you are now into the next tax bracket. That's not to say that triggers the entire amount to be taxed. So you'd only be taxed on the excess amount, meaning in my example, if I have 100,000 that was taxed at that first tax bracket to 15%, that'll be taxed at 15%. And then the excess, the $1, the $1,000, whatever it is above $100,000 will be taxed at the next tax bracket. Why that matters is if we're accelerating income and making more income happen in the current year by, say, a Roth conversion, now we're saying, okay, well, instead of waiting maybe till next year while we're making less money and having it be taxed at 15%, we're now making this money get taxed at 20%. So unless you're really watching where your income levels are and where you're landing on those tax brackets, you could be paying additional taxes for really no reason unless you need to. So these are the type of considerations that make it important to have financial advisor and CPA in the room at the same time.
Thanks so much. I haven't had very many CPAs be able to explain that so succinctly. I appreciate it.
Yeah. So I'm going to go ahead and talk a little bit more about the proactive tax planning side. When you're looking for a CPA, it's always great to have a CPA that understands a little bit on the investment side and hopefully has a relationship with your wealth advisor or a wealth advisor in general. I mentioned before, a lot of times your documents are collected after the year end and your taxes are filed. And unfortunately, there's not too much you can really do to impact the prior year taxes. So having proactive tax planning meetings, especially around the fourth quarter, is really best practice. By that point, you have a decent sense as to where you're going to land for the year. And knowing what assets you have and what gains you're going to be experiences can really help determine whether you're going to do things like a Roth conversion where you can accelerate income, or put in other tax strategies that can help you. Also, it allows for you to have a position where no surprises happen when your taxes are due. Oftentimes, if your CPA and your wealth advisor are not talking together, CPAs may be unaware of any capital gains that you've had happen over the course of the year. So these are things that aren't necessarily being accounted for when you're talking to your CPA about your tax picture in the upcoming year. Additionally, another thing that you may want to talk about a little bit more closer with your CPA, or what are your estimated tax payments out there? I have clients sometimes that are like, well, I wasn't even aware I should be making estimated payments. So, what are your estimated tax payments? Should you be making estimated tax payments? Can you adjust those estimated tax payments? And a lot of these pieces really are coming from the financial advisor, because we're getting that information on a live perspective of what's been happening in the portfolio over the year. Sheldon, anything you want to comment on that a little bit?
I just thought in terms of the proactive thinking is that I think a lot of it is on the wealth planner, the financial advisor, to make the client aware that as different strategies are proposed, that these could have different tax implications. And we're not, unless you're dealing directly with a proactive CPA who can run a preliminary of what taxes are going to look like, you could put the client in jeopardy of a tax surprise. To me, that's the worst nightmare. I can't stand someone getting shocked or surprised when it comes to tax time, that they'd had an unexpected capital gain or some other unexpected tax consequence that wasn't preemptively thought out. So that's what I figure is my safety valve, is that if I make a recommendation, if I think we're going to have some consequences there, I'm like, let's bring a CPA into the conversation and make sure we're not going to have some unexpected tax piece. But then that is nice to work with a CPA who's also forward thinking like that, not just trying to say, hey, I got you the best tax deal for this current year. Forward thinking is what's going to eliminate surprises.
You have a good question here, and I do want to address it right away since we're talking about this topic. This is the question: life circumstances sometimes change throughout the year. Is a 6-month tax checkup instead of an annual tax checkup advised? And they've recently retired and they're trying to navigate a smart financial plan.
Yeah, so 100%. If things are changing in your life and your income is drastically changing from whatever the circumstances may be, I recommend reaching out to your CPA. I reach out to my clients 4 times a year, and it's always around that estimated quarter payment. And I tell my clients, are you selling a house? Are you investing in something? Anything that changes your income or changes your financial perspective from a larger scale, it's always worth noting, because really once you hit that year end, there are very few tax strategies and very things you can do from a retroactive perspective. So I say it's always safe to let your CPA know what's going on. The worst thing they can, or best case scenario is they're like, there's nothing major to note here, and they're aware of it going into the year end. And I'll let Sheldon tackle that from the financial side.
Yeah, so what I appreciate is that since Jonna and I on our shared clients have disclosures where they know, want us to talk to one another, Jonna will CC me on those emails that just go out quarterly and say, hey, anything changing, anything going on? And it was funny, as we were closing out 2022, she had some interesting comments from clients that said, man, I'm so bummed I didn't take you up on those intra-quarter conversations, because here we are in the fourth quarter and there's things we got to sort out. So, we can do the best we can. And we know that people are reading these emails. Sometimes we just have to provide the extra motivation to actually, let's have the conversation.
All right, Jonna, do you want to go ahead and tackle this one about capital gains?
Yeah, so capital gain considerations, we included a little piece on this because capital gains, I would say, are one of the bigger pieces where CPAs and wealth advisors are working hand in hand. It's really about your investments, how they're performing, what they look like over the course of the year, and really just educating you all on some of the things that you can be considering or bringing up to your CPA, or even just asking about. So there's a few different strategies that do come into play. Tax loss harvesting being one of them, without getting too in the technical weeds on this. And a year where you might be having a lot of capital gains and you want to offset that. Maybe you've had an investment that you've held on to for a really long time that's not doing well, that you don't anticipate to do well in the future. Tax loss harvesting is a strategy where you can sell some stocks or shares or investments at a loss and offset any capital gains. This is a great strategy to have your CPA and your wealth advisor in the same room, because there have been at least times where Sheldon and I have worked together where we thought tax loss harvesting would be a great idea. We run the numbers and the tax savings just aren't worth the offloading the investments. The impact of high capital gain years, this really goes back to what we were saying about, all right, if you're making a lot more income, where is this putting you from an income tax perspective? And then communication of capital gains and their impacts. I've had clients before where unfortunately I don't have a relationship with their wealth advisor, and I've had to be the bearer of the bad news that they are paying a significant amount in taxes because their portfolios did well. It's a blessing and a curse, right? You have all these capital gains and you're experiencing, income, but you do have to pay the taxes in the year where the gains happen. When we were going through these slides, I really liked the example, or I liked the background of the piggy bank, because I think it leads for a very good way to explain. I have clients getting confused sometimes about, well, I have all these capital gains, but I don't actually have any additional cash in my pocket. What's happening here? So with a lot of times with these portfolios, there are trades or allocations that happen through the year on your behalf. It's why, we pay for wealth advisors and have these people in our corner doing this work for us. But just because you don't receive the money doesn't mean that money isn't getting reinvested. And the way that the taxation works on those capital gains is you are taxed on the year it happens. So if your wealth advisor sells something, you experience a gain and they reinvest it in something else, you still have to pay the taxes on that. So just having that open line of communication between your wealth advisor and your CPA really helps situations like that from happening. And it really becomes a no surprise type of situation.
Yeah, that's what John and I are the same. I know she takes it very personally when she has to deliver bad news to somebody on taxes. So neither of us want to have that conversation. I just want to expand real quick on this, on the capital gains story. There was a scenario that John alluded to where this particular client, we were looking at a sale they had of a condo in Hawaii. So they had some significant capital gains on that. So we thought, oh, perhaps in a year like 2022, there were significant losses in the market. So we thought, oh, maybe we should see how much of an impact that would have. So the contrary view that we thought of was that these portfolios were also, we knew they're going to come back. So do we want to lock in those losses? Do we really want to lock in those losses? Was there enough impact of harvesting those losses to put a dent in the big capital gains they had from the condominium sale? At the end of the day, no, it wasn't. And I thought, isn't it better for this situation to give those portfolios a chance to recover? They will. And the amount of offsetting losses wouldn't really have put a dent in the large capital gain. So there we had a scenario that we go, okay, we vetted it, we thought it through, we looked at it from different angles and advised the client accordingly.
And that's just, it's such a great example too, because had I just been working on my end, on just being a CPA, not knowing the market, not knowing how the markets are planning on recovering, I would have automatically been like, oh yeah, of course we want to lock in these losses. You know, from a tax perspective, this is a great idea, but having a wealth advisor next to me telling me no, because XYZ, it really gets that holistic approach and planning and making sure that we're looking out from your clients on a full picture, big picture perspective.
And I think it's a point, that last bullet about capital losses offsetting capital gains, I found that's a big point of confusion for my clients. So they're a lot of times lumping the capital losses over and saying, okay, that could offset their income, and a lot of confusion. So it's a very nice for me to be able to pass that conversation over to Jonna as a CPA to give some clarity. And these are confusing. It's unless you do this all the time, it's a very confusing topic about what do you mean capital gains are on a whole different, bracket. But that's what we're here for.
So we've talked a lot about Roth conversions, and there's, a lot of good reason for it. It is a strategy that we have the ability to use. It's a strategy, just for people that are tuning in that may not be aware of it. It's you take a Roth IRA and you convert retirement assets that are pre-tax into post-tax dollars. So what that means essentially is you're going to recognize any tax consequences in the current year, and in the future, when you're able to pull those funds out, they are now non-taxable. So I think a lot of people's reaction is like, oh, well, why would I want to pay taxes now? Well, that is a great question for your CPA and your wealth advisor to work on together. I think when Sheldon talks about the buckets, having different buckets when you approach retirement age is a huge benefit, because if you start pulling out funds and you are being taxed on everything, where's the cash coming from to pay those taxes? Having some post-tax dollars in the future really gives you that opportunity to have a blended approach and be able to pay off any tax consequences. But where the planning really comes in this is your CPA is going to be the one next to you saying, okay, what are the current tax laws? What is on the docket that could change our ability to either do these conversions or change the tax rates in the future? What type of income are you going to be experiencing to put you in XYZ bracket? So Sheldon and I use Roth conversions a lot with our clients, and we do it in a sense of how much money can we convert in the current year to get us right up to whatever tax bracket we're looking at, so that our clients in the future have the ability to have funds taken out retirement that are non-taxable for whatever that may be needed for.
And this is really a year over year strategy that we'll visit. And it reminds me of the capital gains topic that we just left. So if we have a high capital gain portfolio that comes to us and we don't want to take all that gain in 1 year, we'll spread that out over a period of years. Same with Roth conversions. We want to look at that each year. And in the year that someone retires, a lot of times it doesn't make sense because they have all that income to report. But in subsequent years, maybe their only reportable income might be Social Security coming in and their money they're pulling out of their IRAs. So we'll spread that over a period of years, and Jonna can run a model to say this is what it would make it look like for you for taxes. And then when you come to pay those taxes, where's that money going to come from? We typically don't want that to have to come from an IRA account. That's better paid from a taxable account or a cash savings kind of account. So that's why we want those different buckets of money in retirement, so we can pull money from them strategically at different times.
And that's to circling back to why it is important to be upfront and communicative with your accountant or your CPA, because say you are having a year where maybe you're taking a few months off and your income is going to be lower, which we've had clients to do before, that's a great opportunity to do that Roth conversion, take advantage of a lower tax bracket. The more we know as CPAs and wealth advisors, the more we can use that information to advise you.
We did have a question come in, and just I'm glad that you mentioned a little bit about the vocabulary. If you can explain how a Roth conversion works, they're asking if you're converting a 401k to a Roth, are you paying the 401k taxes, or can you explain what taxes you are paying when you do the conversion?
Sheldon, I was going to let you take that question, but I can take it if you'd like.
Yeah, let's go back and forth. Do you want me to lead off? And
Yeah.
So typically what we see is a person is not going to do these Roth conversions until they're in retirement, because you're not then dealing with your regular income coming in. So by the time someone's in retirement, normally the 401k is not there anymore. We typically see that people would roll the money out of the 401k when they leave employment at their primary employer. Once they separate employment, they can roll it from the 401k into an IRA. Although the money is considered the same, the way the IRS looks at it, so 401k money is just like IRA money. So this is where the lingo gets, somewhat confusing. So you could think of the money in the same fashion, but in the scenarios that we mostly deal with, they already have the money in an IRA. They're already retired. We're beyond the years where they have other earned income, and then we just start planning. Typically, we're planning these Roth conversions around people that may have very large required minimum distributions. So the RMDs, if you've heard that, required minimum distributions, they had been at age 72 this year. With Secure Act 2.0, they're getting bumped up to age 73. So by moving the money out of the IRA, which is similar to the 401k environment, then those won't be subject to required minimum distributions. So a lot of the timelines that John and I will look at will say, if we had like 5 to 7 years before someone hits that required minimum distribution age, we'll use that as a timeline to say, okay, what's reasonable here? How can we plan this year over year to pay tax on that money as it leaves the IRA or 401k? And not to say that there aren't some people that do leave their money in 401ks. If they love their employer and they're very happy with it, some people do. Okay, so that is a possibility. I'll turn it over to you, Jonna.
Yeah, and I think just from a tax perspective, you are paying the income tax on that 401k at the time being, and where it kind of becomes a strategy is it worth paying now? And Sheldon did mention a lot of people wait till retirement. That doesn't mean you're required to wait till retirement. The reason why people do wait till retirement to do a lot of these conversions is if you're bringing more income to the picture and you're already in a certain tax bracket, because you're, say, taking in wages every year, it may bump you up to the next tax bracket, which wouldn't make the most sense. So it really is going to be, are you in a position where you're willing to pay the income taxes on that conversion in that year? And it's a balancing act, because it really depends on how much income you're getting in the current year, how much income you are expecting in the future, what your tax rate looks like now versus what you think your tax rate's going to look like in the future. Mind you, it's all variable because life changes, income level changes, tax laws change all the time now. But the high level, yes, that is what happens. You're paying the tax on the 401k or your IRA, whatever the account is, and putting it in that post-tax bucket. Once that's in that post-tax bucket, it can grow tax-free. And when you're ready to take that money out, you can take that money out without having to pay that income tax on it.
All right, is this one mine?
This is both of us. I will go ahead and open it up though.
Perfect.
So we talked a little bit about the tax loss harvesting strategy that Sheldon talked about with the condo. Another great example that we recently ran into is the Roth conversions, which we've been talking a lot today. I have clients that come to me all the time because Roth conversions, I feel like, have been a big buzzword out there. So people come to me, they're like, oh, what is this Roth conversion I keep hearing about? Is this a right strategy for me? Should I do this? And the answer is it depends, and it depends on where your income tax is. And one of the things that we do when we have clients come in is we really look at, all right, what amount of or what is in your portfolio in general? Like, are we saying that there's, $1 million in here and we want to make some of this post-tax in the future? What we'll do is we'll start running numbers based on what that person's taking in from a wage perspective and what other considerations that we may have to do. And then look at ranges. We give our clients a range. We're saying, okay, between a conversion of 50,000 to 100,000, this is what taxes you would expect. And it really is going to be different client to client. We have had clients where some years we are doing $100,000 Roth conversion, and then the next year, all of a sudden they get a big bonus that they weren't anticipating, and now the Roth conversion doesn't make sense anymore. So it's really crucial for you to have these conversations on an ongoing basis with your CPA and wealth advisors at a minimum towards the year end. But like we said before, if there are changing factors, it's always better to get those in front of your wealth advisor and CPA as it's happening live.
Yeah, and I think Jonna kind of made that face when she said tax laws change more. I mean, isn't it true, Jonna, that tax laws have now begun to change far more often than they had over the last decade? Now, seems
yes.
like a year.
Yes, every year. Well, I'm not going to say every year because I don't want it to be every year, but we just had tax laws that have changed as of last week. So it changes all the time. And I think it's, if you get anything from this presentation, not to steal your thunder, Sheldon, but if you're not working with a CPA, I definitely recommend working with a CPA in the future, considering with it, just because things are changing so rapidly, where historically they've not changed as often as they do now.
Oh yeah, no, she didn't steal my thunder at all. That's that's good.
Oh, and look at this, tax laws change, the first bullet on this slide.
Oh yeah, there we go. We're preceding ourselves. So year over year planning and even tying into that strategy idea. One example I thought of would be that young savers are a lot of times advised, rightfully so, to get money into those Roth IRAs because they have lower income. They're not worried about they can barely max out the Roth. But what a great place to put money if you're in your 20s and that Roth is going to grow tax free. So super good advice. So say you're in the habit of doing that, and all of a sudden one year you find out, oh, my income is too high. Now I've exceeded the threshold allowed in tax law to put money in a Roth IRA. I've got to switch it up. What's my next strategy? So I think that's why you need to constantly get advice about where to maneuver as your income grows and you surpass these limits. This since I'm not a tax preparer, my non-tax concept is if I tell somebody they figured out a way to game the system with tax, it's not going to work. That means as soon as you think you've got it all figured out, like, well, I'll just put all my money in the Roth. Well, if you make $300,000 a year, you can't put in a Roth IRA. So if you think you've figured out how to game the system, that's a really good time to get with a tax professional, because that's probably not the case. You're probably phased out for one reason or another.
Yeah, and I think the income and other factors can change. I mean, it goes back to our guest that asked the question about retirement. As things change, your strategies are going to change, and it's likely that they will change year over year. So that's why it makes planning so crucial. I know I mentioned estimated payments earlier as well. I think there's a big point to make on the estimated tax payments is a lot of times, especially if you're using an automated software, like a TurboTax or something like that, or even if just your relationship with your CPA is not so great, they will provide you estimated tax payments, and they're always based on your historical income. So there could be a possibility of, okay, well, this year I'm making a little bit less money. If you're still making those estimated payments, it's very possible you are overpaying. So it goes beyond just a year over year planning. It goes on of, if things are changing, tell your CPA right away, and you can make it more of like a quarterly or half yearly planning type of situation.
Yeah, so I suppose the thought to leave everyone with is that financial planning really is tax planning, and tax planning is financial planning. You don't want to do them in isolation.
All right, we have some time for some questions now, and I have a couple here that we've already received, and then I will tell our attendees if you have another question, go ahead and put that in the chat. We've already had a couple people take us up on that, and so that will be great. You talked a lot about capital gains taxes. What about if you're having your wealth manager rebalance your portfolio? Do you get capital gains taxes on the rebalancing?
I would say it depends on what exactly they're doing. If they're doing a reallocation where they're selling one position and reinvesting that money into another position, it's likely that you will have to pay capital gains tax on that, because you are recognizing that gain. You still are getting more cash back from selling off whatever that investment is and reinvesting it. So that at that time you have to pay the capital gains tax on whatever that piece is. And then the other piece to be aware of that is capital gains taxes are divided in two different categories. This is another thing that you want to talk to both your wealth advisor and your CPA on. There's long-term gains and there's short-term gains. Anything that's considered a short-term gain is an investment position that's been held on for under 1 year. This becomes important because you are taxed at your ordinary tax rates, meaning you're taxed at whatever you'd be taxed at if you were to get $1 from your W-2. So it's going to be higher income tax brackets. If you have anything over a year, it's a long-term tax rate, which is then going to be at your capital gains tax rates, which are oftentimes lower. So keeping a lookout on those things as well are give you opportunity just to save money on taxes.
And we do get that question often as portfolio managers, and we can do those calculations on the fly. So if a client calls in and says, where am I at year to date with capital losses or capital gains? We did that a lot during 2022 because people knew they had more losses accumulating than gains. But I think that goes towards planning, is you have to be able to ask your portfolio manager throughout the year, where am I tracking with this? And that's how it feeds into the proactive planning, is knowing what those are. Because to the point of that question, just because there's a reallocation throughout the year, we might be reallocating to rebalance that portfolio in the midst of losses, which was very common in 2022. But other years, as we reallocate and rebalance, then it could be also triggering gains, which throughout the year your CPA will not be aware of.
All right, we got a good question in here talking about quarterly estimates versus paying it all at once. Can you talk a little bit about what the rules are to that? And they're just a question as to why you would do it quarterly as opposed to all at once at tax time.
Yeah, so estimated payments are not for everyone. The IRS typically, there's certain requirements that you fall under, one of them being that your adjusted gross income is over $150,000. But the quarterly estimated payments really come in for people that are, their income fluctuates a lot year over year. So say if you're working like as a 1099 employee, like a contractor, or you run your own business, or your income is just subject to, you know, highs and lows. You work in a partnership, some sort of type of scenario that would make it so your income is not consistent year over year, especially if you're a 1099 employee where you're not withholding any federal income taxes over the years. Those are the times where the IRS does expect you to pay an estimated payments. If you're a W-2 employee, it's likely that you're having your federal income tax withholdings just taken out over the course of the year, and there's nothing further to do here. Where estimated payments become an issue is if you're not withholding any income taxes over the course of the year. When you go to file your tax return, the IRS is going to say, you should have been paying taxes all year round. We are now going to make you pay your taxes. We're going to fine you, and we're going to make you pay interest on the income tax that you should have been paying over the course of the year. So like I said, it's not a for everyone thing. If you're a W-2 employee and your tax situation is fairly straightforward from that perspective, it's likely you don't have to make estimated payments. But it doesn't hurt to ask your CPA.
All right, let's go ahead and go on to another question. Can you talk a little bit about standard deductions versus itemizing? I know that those laws have changed a little bit, and can you just talk about the advantages, disadvantages of those?
Yeah, so your standard deduction is what the IRS allows you to take, and it's going to vary if you're filing single, married filing jointly, married filing separately. What the IRS allows you to do is, and that standard deduction, just to take a even bigger step backward, is the IRS allows you to take a certain deduction against whatever income you've taken over the course of the year. Standard is what they allow you, and then there's itemized deductions, which you are allowed to take if you choose to do so. Oftentimes, you're going to take whatever strategy benefits you the most. So whatever deduction gives you the greatest amount. It is true that itemized deductions have changed over the course of the years and have become a little bit harder to take advantage of itemized deductions. There are the itemized deductions that are most commonly out there are any excess medical expenses. Excess medical expenses are often very tricky to get because they require you to be, I believe it's of 7% above your AGI. So depending on how much your money you're making, you have to be spending tens of thousands of dollars oftentimes to be able to take advantage of that. Charitable contributions are another itemized deduction. Mortgage interest is another deduction. Taxes, not taxes from an income tax perspective from a federal level, but if you're paying other state taxes. Unfortunately, there are a lot of thresholds now where if you hit a certain like $10,000 mark, okay, we can't do anything in excess of that. So the IRS has made it harder to put you in a position where taking your itemized deductions is more beneficial. I wouldn't say there's necessarily a strategy on taking itemized deductions versus standard deduction. I will say when you're talking to your CPA, it's always worth double checking if you can itemize deductions. I think oftentimes it is a CPA's default to say, oh, we're going to take the standard deduction. If you know you are incurring a lot of medical expenses or that you have home mortgage interest, and that can be for multiple properties, if you know you're paying a lot of sales tax and you're keeping track of it, or you're paying state taxes, whatever those be, have your CPA check on those, because if you can take a higher itemized deductions, it's worth doing. The other point that I will say, and it's a strategy that we actually didn't talk about today, don't lose your standard deduction or your itemized deductions, and you can lose them. If you are not making the income to net out to zero, you are losing those itemized or standard deductions. And what I mean by that is you can't carry over itemized deductions year over year. So say you were able to calculate your itemized deductions and you have like $40,000 of itemized deductions. If you don't have $40,000 of income that year, you just lost those itemized deductions. So that's another strategy that you can use in going to your wealth advisor and saying, I know I'm going to lose my itemized deductions. Is it worth doing a Roth conversion where all of a sudden we're creating more income so you don't lose that? So that's money you're leaving on the table. So that was a mouthful, but standard deduction, itemized deductions, huge concept. It's harder to have those itemized deductions, but if you can, take advantage of them.
All right, and we have time for one more question, and then we will have to end here today. If you're leaving a job and you're not necessarily retiring, can you do a Roth conversion on that retirement account from the job?
I think that might go back towards that one example that I was painting, where typically when people leave employment, that 401k is eligible to roll into an IRA. So then they're controlling how that money's invested instead of having to just only use the options inside the 401k. So especially people that change jobs a lot, like maybe in the tech sector, not uncommon for them to have 7 different 401k plans that are just kind of hanging out there. And then they'll meet with a financial advisor or help them consolidate those. Those are typically consolidated in an IRA. But what the example that we gave was people usually aren't doing Roth conversions while they have earned income coming in, because if you did convert it, it just adds to your income for the year. So typically the Roth conversions are strategies that we see later in life into retirement after earned income has decreased.
All right, well, that's about all the time we have. So many great questions, folks. Thank you so much. I want to remind you, if you have not had a chance to have your question answered, please leave your contact information in the chat. We'll make sure someone reaches out to you after this event. On behalf of Advice Chaser, we want to thank our speakers today and want to thank the organizations that have made this webinar possible. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.